There's only one thing I like more than Bitcoin, and it's more Bitcoin. I do think we can outperform Bitcoin. That's a pretty hard baseline to beat. We're talking hundreds of percent per year potentially. If we can basically double or triple that with just a couple trades every few years, then that's pretty preferable. There is allocations that I am using to actively try and accumulate more BTC. We've now built a solid foundational base, and we've already proven that 100k can be broken quite easily. Once the macroeconomic conditions become more favorable, the sky's really the limit for BTC. We've seen, $37 billion of net inflows. That's over 10 times the inflows gold saw in its first year of its US ETF launch. And everyone looks at the gold price action the years following that launch and that fractal where gold ran up exponentially for multiple years. Bitcoin could be on the cusp of that. 2025 does have the potential to be something spectacular like we've never seen before, especially looking at the on-chain data. This isn't an opportunity that comes around very often, an asset that we've all had access to. There's not many assets where retail can get in before these big institutional players.
On-chain data. You're the second person that I ever talked on the podcast, which is I feel like this topic should be more popular on the podcast. I talked with Checkmate. You probably know him.
I know him well.
And
yep.
you're now the second episode. Now I can make a playlist with on-chain data on my channel with on-chain data. So thank you so much for taking the time and coming on today.
No, of course. Thanks for having me. And Checkmate's obviously one of the best minds in the space. So the bar's set pretty high for me today to try and give some unique on-chain insights and try and educate the audience on maybe what we do and how we can help your own investing and analysis. But yeah, just as a little bit of background as who I am, I'm Matt from Bitcoin Magazine Probe. We're the data and analytics branch of Bitcoin Magazine, who are the oldest and most established Bitcoin publication on the web. And we host the Bitcoin conferences and stuff like that. And yeah, we only really partnered with Bitcoin Magazine, our on-chains data platform, which used to be called Look Into Bitcoin earlier in 2024. I think it was June or July time. And since then, yeah, we've been able to kind of expand our reach and provide more and more data and analytics, as well as macro data and portfolio tools, etc., just to really try and simplify your investing, not only from a performance standpoint, but also just from a time and understanding standpoint. I feel like a lot of on-chain data gets a reputation of being incredibly complicated and unnecessarily so. There's so many charts you can look at which really paint a picture in black and white of what is happening in the market. Are we in a bull cycle, bear cycle? Are we close to a peak or a bottom? And from there, it just, yeah, as I said, can massively save you time and improve your own investing by removing that emotional bias, by just purely looking at a data-driven approach to, yeah, try and outperform the vast majority of people.
In the end, it's all about getting more Bitcoin, I guess, right?
Exactly. I like to say there's only one thing I like more than Bitcoin, and it's more Bitcoin. So I know it's a slightly controversial take with people in the space, but I'm openly going to say this cycle I will be selling Bitcoin in hopes that next cycle I can buy even more Bitcoin. I don't know about you guys, but I work in Bitcoin space full time. So obviously I earn a lot of my salary in Bitcoin and stuff like that. But the best way to actually increase my stack will be to try and time scaling out of the market towards a cycle peak and then towards the cycle bottom after a 60, 70+% drawdown potentially. That scaling back in is going to massively outpace salary and any other small trades I make, because that macro part of my investing portfolio, yeah, if we can basically double or triple that with just a couple trades every few years, then that's, pretty preferable.
Interesting. What do you think is the, probably impossible to guess exactly, but what do you think is the percentage change of how many more Bitcoin you can probably get if you are good in this and if you actually try to learn from the on-chain data? Did you had some, or did you run with your own DCA strategy analysis of like what would you get if you just stack every month versus what you have now?
So it's a very good question. I think a lot of this also comes down to personal preference. I, for example, like to spend as little time as possible in front of the charts, so I can be someone that can scale in and then every few months maybe take a swing trade or so, but then scale out quite heavily, potentially 2 or 3 years after I've really heavily accumulated. Whereas we get a lot of people who use on-chain data because, again, it's not just something that we can look at on a macro basis to say, right, I buy in 2021 and then I wait, years or so to sell. You get people that are using this on-chain data on an intraday time frame who are looking at buys and sells from big accounts as they're happening in real time. All that really drives the market is supply and demand economics. And using this on-chain data, we can see people selling and buying Bitcoin as it happens. So they may be making 5 to 10 trades a day, in which case our returns might be slightly different. At least that equity curve might be slightly different. But I do like to think, as a baseline, using this on-chain data, I do think we can outperform Bitcoin, which is a pretty strong baseline considering Bitcoin is one of the best performing assets globally in the last decade, going from, a few $100s a decade ago to over $100,000 pretty much to where we are today. That's a pretty hard baseline to beat. We're talking hundreds of percent per year potentially. And if we can outperform that with just a few trades, because obviously then you have to consider taxes, funding, fees, slippage, etc. That's all going to be a detriment on performance. But as a baseline, I think using this on-chain data and taking an unbiased, risk-managed approach, I think you can outperform just buy and hold, which, as I said, is a pretty hard baseline to beat. But we do have quite extensive research showing that this is possible. And the reason I got into on-chain data and analytics to begin with is because that's what I heavily relied on over the previous cycle to, again, make up for the mistakes I made when I first got into Bitcoin. I'm not sure about yourself, but when I first got into Bitcoin and I was learning about trading and investing, and I was in TradingView every day with 1,000 different lines on my charts and 50 different indicators trying to find the holy grail, massively overcomplicating things. I ended up buying the top, selling the bottom like most people do. It was only after that where I really deep dived into Bitcoin, its technology, the blockchain, everything beyond that, and realized we can actually see all of this transaction going on. We can see all of the movement on chain. We can see these experienced large players begin to accumulate and distribute their coins as it's happening. We can just follow them. We don't have to have an edge that's, so unique and complicated. We can just wait until the best, most profitable traders are selling and sell alongside them, or see when they're accumulating and accumulate alongside them as well. And so I'm a big proprietor of using this data because I have the evidence from myself that it worked in the previous cycle. And then since I kind of made this my job to try and educate people on-chain data and the topic of Bitcoin, we were accumulating heavily around the $15,000 to $19,000 region. The previous cycle lows we've had now, when we reached 74,000, we were already identifying that we're maybe a little bit overheated and having a bit of a cool off. And now above 100K, we're getting a few signs that maybe in the short term that prices may be overextended a little bit, but we have had a few weeks to cool off. So it's really interesting to see how this all kind of confluence merges together to give us not just a big picture on a multi-cycle, multi-year basis, but also in these swing micro, intra-cycle moves.
Are you doing this with a significant amount of your stack, or with only a small amount of your stack to keep the risk lower?
So personally, I have a few different allocations of my portfolio. So I even have my own pension pot in Bitcoin, which is pretty out there. I managed to get that in 2018. So that's an amount of Bitcoin that I won't be able to touch for decades. So this isn't like I'm selling and accumulating with 100% of my Bitcoin. There's a certain amount that I'm never going to touch. There's a certain amount which I'm DCAing with, which is, like I said, through salaries and whatnot. There's a certain amount which I won't touch for decades, but then there is allocations that I am using to actively try and accumulate more BTC, which it's hard to give exact percentages, but if you imagine almost a 33%, one third split, a third you're never really touching, a third you're adding to, and then a third you're maybe actively trying to increase your stack by going into the market at the most opportune moments and trying to sell at the most opportune moments.
Interesting. A question that I probably should have asked in the beginning of the show. For the few people that maybe don't know, what exactly is on-chain data and what insights can we really get from there if maybe someone is wondering now?
Yeah, we maybe should have started with this. So really quickly, on-chain data. Bitcoin is built on top of a blockchain, which means every transaction is publicly available. We can see every transaction, we can see every wallet, and we can see in real time what they're doing, what trades they're making, the sells, the transfers, etc. And what we can do with that data is essentially form a picture of what the supply and demand economics of the Bitcoin market are in real time. We can see if lots of, like I said previously, large, long-term, experienced traders are beginning to transfer some BTC at the tail end of bull cycles. And historically, we can monitor these wallets to say, wow, they are pretty good at timing the market. We can take some inspiration from those. But essentially, all it is just collating every single one of these transactions. And then we can manipulate that data in certain ways to help our own trading and investing, depending on, like I said, if you're a long-term investor, a DCA, someone who's just interested, someone who's actively day trading. But yeah, I mean, if you looked at the US economy, for example, when they're looking at all of the transactions based on, well, cash is harder to track, but in the digital money movements, that gives them a huge amount of insight into what they can do with inflationary rates, etc. But we don't have that data publicly available. This is where Bitcoin is quite unique in that everyone has access to this data freely. All you need is a Bitcoin node to spin it all up. Or if you use a platform like ours, where you can see all of this data nicely visualized, so then you can help make your own decisions based on that.
Interesting, really cool. What are, maybe we can start off with some of your charts or metrics right now. What are the most important ones that you look at, and why are they important, and what insights are you basically gaining from them?
Yeah, great. So I'll just share this one, which is probably our most popular chart we have on the site, which is the MVRV Z-score. So you only need to really know one component of this, and then the rest of it kind of makes a little bit of sense. So first and foremost, if I just remove this orange line, and the Bitcoin price action is what we see, this black line here. This is the market cap, so the circulating supply of Bitcoin just multiplied by the price. And this blue line here is the realized cap. Now, the realized price is the average accumulation price, or the cost basis of all BTC on the network. So what we can do is basically aggregate every single Bitcoin transaction that's ever happened, look at the USD value of BTC at that point in time, assume that that transfer was either accumulation or sale of BTC. And then once we get all of that, again, we can multiply that by the circulating supply to give us the realized cap, which is, if you want to look at it, the average purchase point of every BTC hodler, but this is just in market cap terms. So once we have that, we can just simply divide the market cap by this realized cap to give us the MVRV, and then we standardize that data over, depending on its volatility throughout Bitcoin's history, to give us the MVRV Z-score. So that sounds pretty complicated, but for those that can see the chart currently, what we're seeing is this orange line representing the MVRV Z-score, shows us when Bitcoin is incredibly increased in terms of its percentage above this average accumulation price. So people are in 2, 3, 4, 5 times profit based on the average cost basis of all BTC holders. And once we get further down here, beneath a value of 0, which would indicate a majority of Bitcoin is currently being held at a loss. Now, what we can see with a lot of on-chain data is this is essentially just mass psychology quantified. That's all it is. All we're seeing is in real time if people are bullish, incredibly greedy, etc., or fearful, wanting to sell. And what we can see is when most people are at a sell, this is counterintuitive to human emotion to want to accumulate into an asset which you may be holding at a loss. But what we can see from this is when a majority of people are at a loss, once we're in this green zone on this chart, that signifies the most opportune risk-to-reward moment to begin heavily accumulating BTC. What we can see in the previous cycle, the previous bear market, and towards the tail end of 2022, this basically crossed beneath this average accumulation price. We're looking at the market cap here rather than the price, but it was around $20,000 all the way down to about $15,000. And on that run up we had in January 2023, a couple of years ago now, at that point we crossed back above, and that almost signified the start of this bull cycle. And what we can see is in previous cycles, once we get to these incredibly high values, once a vast majority of people are making excessive gains, unrealized gains, when people are taking screenshots of their P&L and sending it to friends and people are FOMOing in, this is when you really want to be looking to take some risk off the table, when you maybe want to be locking in some profit, which again is hard to do in that moment when you see your portfolio has made a 5x or even a 10x or something. This isn't a moment in time where you need to think to yourself, oh yeah, maybe now's the time to stop. That's so counterintuitive to feel. You want to put more money on the table into an asset that's making you this much profit. But this is where these data charts can really help to see, these patterns are somewhat predictable. We can see throughout history, once X amount of profit has been reached by a majority of investors, this is usually when the market's getting a little overheated. And the same for the downside. Like I said, once a majority of people are at a loss in their positions, it's usually a good idea to do the opposite and start accumulating when other people are distributing.
I like the idea of a weighted DCA of like more targeted DCAing, where you see when you see the data and you're like, okay, here we are most likely at some sort of bottom, so I'm trying to buy in with more and trying to buy a little bit heavier here, and if we are more up, I'm trying to not buy in as much as I can. With selling, I feel like there's a risk of like, what if we hit a weird like .com bubble point where all of a sudden all the prices completely shoot up? Yes, there's the argument it probably will come down, but what if it doesn't come down? I guess there are some risks to that, even though the chart already 15 years is kind of predictable. What are you saying to like, what if we shoot up too much in like maybe a strategic reserve national bank FOMO situation?
Of course, and that's definitely a hot topic at the minute. I remember in the previous cycle, we also had discussions of what if we see a Bitcoin super cycle or something like that. But I still stand by the number one thing that's actually moving markets, moving the Bitcoin price, is supply and demand economics. Obviously, if we see a US strategic reserve launched, and that's 1 million Bitcoin that needs to be accumulated, that's a huge increase in demand, and supply is staying pretty stagnant. We're not seeing a huge amount of new Bitcoin flooding into the markets every day. So that 1 million Bitcoin is going to have to be bought at considerably higher prices than the current market, whatever people are willing to sell at. But ultimately, the thing that is going to determine when the top is in is when people are selling and demand isn't increasing to match that. So if I can share another metric here, that may be good to show.
Let's do it.
Great. 2 secs. There we go. So this is a great metric that's going to help me try and time the top. And again, it's always going to be impossible to sell 100% of your position at the exact market peak. But what we can do is see periods where there is some signals that we're getting a little overheated. So this is the value days destroyed multiple. And as we can see, it just shows very cool periods here and very hot periods when this metric gets red, which has historically signaled pretty major peaks in the Bitcoin price action. Now, what this is doing is actually weighting the transfer of Bitcoin, also known as the coin days destroyed, by the amount of BTC being transferred and the amount of time being held. So that might sound a little complicated, but essentially if I held 1 BTC for 100 days and then transferred it to sell, I would add 100 coin days destroyed. If I held 0.1 BTC for 1,000 days, it would equal the same thing. So what this is doing is when we see traders who have been holding BTC for a very extended period of time, who have maybe held Bitcoin since it was just a few $100s or even less for many, many, many years, once we see these begin to start selling, that's a huge amount of supply flooding the market. And you have to consider, once Bitcoin's price is at 100,000 plus, maybe we peak at $150,000, $200,000, who knows, the amount of capital inflows required to actually scoop up that amount of BTC entering the market is substantial compared to the amount of USD required to purchase that Bitcoin years and years ago. It's an incredible amount of capital inflow required. So of course, if we see a strategic reserve, the market dynamics change a little bit, but it's hard to base our strategy on if, buts, and maybes. So far, what we can see from the data is, such as when we peaked in March, February 2024, this was incredibly high. When we reached the first all-time high around $73,000, $74,000, we saw a huge amount of profit taking by long-term holders. And then following that, we saw 7 months of pretty stagnant, choppy, consolidationary price action. And the same is true for pretty much all of the Bitcoin peaks. What we can see is when lots of people are selling, that usually indicates a market top, especially those who have a lot of BTC accumulated at lower prices. So of course, selling at the top is going to be incredibly difficult. But this is why, such as scaling in at the bottom, people like to dollar cost average in. Like you said, if we can strategically dollar cost average in, metrics like this can help us strategically dollar cost average out. But the thing with Bitcoin is there's typically long periods of time where there's not a whole lot happening. During most of Bitcoin's price action, you probably want to be quite stagnant. So I've just zoomed in on the price action here. If you were able to accumulate quite heavily between $20,000 to $15,000 at the tail end of the last bear cycle, yeah, maybe you were taking some profit, $74,000 and slightly below $100,000. But once we look at other metrics for confluence alongside something like the value days destroyed, the MVRV Z score, etc., we kind of get a better idea of when to start scaling out. And that might be a couple of years after, but then hopefully you've scaled out sufficiently enough. Obviously, you're never going to sell 100% at the exact peak, but just enough so that in a couple of years' time, again, once we're at the tail end of the next bear cycle, you have enough capital to reaccumulate considerably more than what you started with.
It's almost like on-chain data kind of mirrors the human psychology between buying and selling and the free market dynamics.
Yeah, of course, of course. And I think, like I said, there's quite a lot of indications that this data is really pointing towards the counterintuitive nature of Bitcoin and investing in general, and just the human psychology with this. Looking at something like the Fear and Greed Index, which is one of the most popular kind of technical charts people look at to kind of gauge sentiment in the market. Once we see an incredibly overly greedy sentiment, this is when a lot of retail coming in who maybe aren't experienced are wanting to FOMO in. They're not selling BTC. They're feeling greedy at that period of time. This is where we can see the divergence between these larger, more experienced traders who are taking profit and scaling out of that period of time compared to these new capital rushing in. And same is true for the downside. Once we see people flooding out saying that, we're going to crash to 10K, 1K, even after a 10, 15 retracement, 15% retracement, now, we're already seeing people saying, 50K, 60K could be possible in the next few weeks. Realistically, this is just human emotion getting the better of people, when actually, if we're looking at data, we're actually seeing a decrease in the amount of profit taking currently, and especially with the ETF inflows that we're seeing demand start to scoop up that excess supply, hopefully building a solid foundation for the next leg higher.
Interesting. How big of an effect does the overall monetary expansion and the M2 money supply and all those things come into play with on-chain data? Are there any correlations between the on-chain data and M2 money supply?
Yes, so I have just the chat for you. Once again, if I can just screen share here, just give me 2 seconds. What we have here is the global M2 versus BTC year-on-year chart. Now, of all of the macroeconomic data points, this is one that has almost exactly a one-to-one correlation. When we see massive expansion in global central banks, balance sheets, and just general money printers going, we typically see Bitcoin massively appreciating in value also. And the same is true for the downside. Once we see a contraction, once we see the money printers going down and we see governments maybe tightening up a little bit due to fears of a recession or something like that, is usually when we see Bitcoin's worst periods of performance. And this chart really outlines that. If you were to just look at one macroeconomic data point for your Bitcoin investing, it would probably be this one. What we can see is as soon as we see expansion, such as in 2017, following the inauguration of Trump in his first presidential term, we saw Bitcoin rally exponentially, starting at just a 176% year-on-year gains, before a few months later being 2,500 nearly percent year-on-year gains. And this liquidity cycle is pretty interesting because either coincidentally or due to some genius policies from Satoshi, this has coincided very nicely with the 4-year cycle we typically see in Bitcoin, partly due to the halving events where we see the Bitcoin inflationary rate drop by 50%. Historically, that has also aligned pretty nicely with this global liquidity cycle. So we get these big, massively increased bull markets just due to the fact that there's more fiat currencies flooding into the system, more and more dry powder. Again, we see the supply of dollars increasing with the demand of dollars decreasing. They're looking for hard assets like BTC to try and scoop up a little bit of performance.
I was kind of disappointed with the price movements around the 100K dollar mark. I expected more. I expected not only more from a price. I thought like, okay, if we reach the 100K, we might overshoot. But I definitely expected more from what normally is outside of the Bitcoin community really thought of Bitcoin and maybe kind of more euphoria. But I feel like it was mostly in the Bitcoin crowd. What did you see during that time where Bitcoin broke that 100K and since now it's like dancing around, like sometimes we were like at 102K, then 93K again, and we're dancing around that 100K number?
Yeah, I to be honest, I was pretty much the same. I imagined 100K would be this big psychological barrier where maybe it'd take longer to break through. I was already surprised at how easily that 100K resistance fell. It only took a matter of weeks from being only 60, 70K into new all-time highs to breaking into six-figure territory. To me, that was mind-blowing. But again, I also agree. I shared the same sentiment that I thought it would be major headline news, Bitcoin breaking $100,000. But the reason I think it maybe didn't is because we're maybe, again, seeing macroeconomic conditions that aren't 100% favorable. So what we can see is we have seen the global M2 money supply since around September actually contracting, which one outlines Bitcoin's strength to be able to rally quite exponentially during periods of less than favorable macroeconomic conditions, but also makes me pretty bullish on what Bitcoin can do once we see this trend reverse again. Just because we're seeing a slight contraction in the M2 money supply now doesn't mean that the liquidity cycle is over. What we can see is in pretty much every liquidity cycle, we have periods where it's, pausing, buffering, contracting slightly. But that also ties in with a chart like this, which is Bitcoin versus the US dollar. Generally, investor sentiment in traditional markets, I know the S&P is doing pretty well, but there's still a little bit hesitation, I feel. And that's due, one, in partly due to the contraction in the money supply, but also the rally in strength in assets like the US dollar. What we can see is the DXY here, the US dollar strength index, has again been massively rallying since around September time, as Bitcoin ran from what we can see on the chart here, around $65,000 to above $100,000. Again, outlining the strength of BTC to be able to rally that high after a period of choppy consolidation in spite of less than favorable macroeconomic conditions. And again, this is one of those charts which this isn't going to keep rising forever. Of course, this may be causing some limited upside potential for BTC and causing a little bit of this stagnation beneath the $100,000. But once this does turn, we've now built a solid foundational base, and we've already proven that 100K can be broken quite easily. So once the got lost in my own words there. Once the macroeconomic conditions become more favorable, the sky's really the limit for BTC.
Interesting. It's also this next coming year is for me kind of a joker year where we might have something really incredible in terms of adoption and especially also price development, as it's a kind of scoreboard of the adoption and how bad fiat is doing. What do you expect of this next coming years? Maybe just to summarize, we have a potential SBR, Strategic Bitcoin Reserve in America, which will probably trigger some other countries to at least announce things or do something in the background. BRICS are talking about that. Russia was talking about that. Lower interest rates, money printing with Trump in office, and want to push the markets to higher ETFs now, 1 year in full swing. All those in the ETFs, a lot of people were in the beginning a little bit disappointed. I think it was an amazing start, but all those marketing and sales machines from the ETF providers, they really come in full swing. I think after 12 months, where they have already 1 year of data, and the year was really good, and companies buying. What do you expect from 2025? What you see on chain, but also what's just going on in the macro lens?
It's hard not to get carried away with how bullish things could get in 2025, I feel. Like you've said, with the ETFs, a potential US strategic reserve, we're seeing a massive shift in Bitcoin, whereas in the 2016-2017 cycle, my first cycle in the space, it was almost entirely retail driven. And then following that in 2020, we had these exchanges and institutions like FTX and 3AC leveraging up and trying to pump Bitcoin. But this cycle, we're actually getting this institutional demand and inflows. The first year since the Bitcoin ETFs launched, it was pretty much a year ago to the day as we film this, we've seen, $37 billion of net inflows. That's over 10 times the inflows gold saw in its first year of its US ETF launch. And everyone looks at the gold price action in the years following that launch and that fractal where gold ran up exponentially for multiple years. Bitcoin could be on the cusp of that, especially with corporations like MicroStrategy accumulating, and other companies will inevitably try and follow and repeat that success. We are seeing lots of players coming into the space who truly understand the potential of a scarce asset like Bitcoin, not just as a store of value, but potentially as something as a international settlement product, where we could see nations, obviously El Salvador have already begun accumulating, but like you said, if we've seen nation states already begin accumulating BTC in the background, potentially even exchanging international settlements using BTC, then 2025 does have the potential to be something spectacular like we've never seen before. Especially looking at the on-chain data as well, we are beginning to see people maybe realizing that the amount of selling we've seen on-chain has reduced dramatically over the past few weeks, of people maybe realize this isn't an opportunity that comes around very often, an asset that we've all had access to. There's not many assets where retail can get in before these big institutional players, and this is that opportunity. And the opportunity cost of taking profit now, when the upside potential is seemingly infinite, just seems crazy. So yes, I'm incredibly bullish for 2025, but alongside that, I do try to not get incredibly carried away. I do try and have a 95% data focused approach, because as much as I look at these charts every day practically and have been in the space for multiple years, like I said, it's impossible not to get carried away with this type of thing. So as bullish as I am, as hopeful as I can be on BTC, once the warning signs start flashing, once we do see ETF inflows begin drying up, once we do see large whales begin selling in bulk, at that point, it does make sense to start scaling out, even in spite of potentially incredibly bullish narratives.
I partnered up with Coin Vigilante. This is the most beautiful Bitcoin timepiece that I ever saw created by anyone. Look at that beauty. I love it so much. Coin Vigilante made a perfect Bitcoin watch. That's the perfect, subtle, elegant way to go out there and show that you are a Bitcoiner. And that watch brand is Bitcoin only. And Coin Vigilante just dropped a completely new and amazing Genesis edition of their watch collections. You have the date of the first ever mined Bitcoin block in there, and of course also the block height and which epoch we are currently in. I love the level of detail they put in this masterpiece, and make sure to check out those amazing Coin Vigilante timepieces down in the descriptions. I love those watches so much. If you watch or listen to my podcast on a regular basis, I guess you already bought some Bitcoin. And now the most important step is to keep the Bitcoin. Keep them secure in a hardware wallet. My personal recommendation for hardware wallet is the BitBox. It's super secure. It's simple to set up. It's also a perfect gift for a friend who has still their Bitcoin on an exchange. And you can get a 5% discount with the code Robin at the checkout. Visit bitbox.swiss/Robin to get your BitBox. And the next step is to really level up your sovereignty as an individual. You have to have the most secure self-custody setup. You have to secure your own devices. You have to protect your privacy. You have to set up an inheritance plan. And depending on where you live, you even want to have a plan B, a citizenship where you can move in case something goes really wrong. And through all those steps, the Bitcoin way is guiding you through step by step. And if you visit thebitcoinway.com/partners/Robin, you even get a 30-minute free call to find out how you can level up your sovereignty. Wait, so you've seen selling actually decreasing over the last couple of weeks, which is super interesting. That I think a lot of people see 100K as a natural top if they don't understand Bitcoin, but probably a lot of people that are in Bitcoin understand it. So the struggle that we have right now between like 105K and 93K, whatever we are, is more around the M2 money supply being not shot up and being a little bit smaller down, and not the people selling. Is that correct?
Yeah, so I mean, I can share a chart here which can maybe back that up a little bit. Once again, just 2 secs. And I'm sharing a chart here which is the long-term holder supply of BTC. Now, I've zoomed in just on our current cycle. And what this is showing is the amount of BTC that has been held by these longer, more experienced, potentially BTC holders. Now, what this usually has is an inverse correlation with price. Once we see this massively reducing, we usually see Bitcoin price action massively increasing, because this is when new money is flowing into the space, new buyers are coming in, and these long-term holders are selling their BTC to short-term holders. What we could see is earlier in 2024, when we saw this begin decreasing quite noticeably, it was as Bitcoin's ETF pretty much got launched and Bitcoin ran up to a new all-time high. And then following that, long-term holders, again, realized that this probably isn't the time to be selling BTC. We have this ETF that's just opened the doors for potentially tens, if not hundreds of billions of dollars to begin pouring in. So we saw the long-term holder supply remain pretty stagnant before this started massively increasing. One, from potentially long-term holders accumulating more as Bitcoin consolidated around this area. But again, short-term holders who had entered the market, who saw this as an opportunity to buy BTC to hold for the long term. So then we saw this rapidly increase. And again, that pretty much marks the bottom before Bitcoin ran up to above $100,000. And as this has begun decreasing, it's really fueled this move we've seen. But over the past few weeks, really, we've seen the rate of decline begin to decrease. And now we've actually seen this flat line as Bitcoin has reached the mid to low $90,000 levels. Again, we're not really seeing a huge amount of profit taking place. And if I just zoom out, we can really see the impact of this over Bitcoin's entire history. Clearest indication being in 2016, 2017, where as the long-term holder supply absolutely bottomed, it almost marked the exact top of the Bitcoin price action, at which point all of this began increasing again as new money stopped pouring in, Bitcoin's price topped out, long-term holders had banked all the profit they wanted to, and then the cycle begins again. So I do think we're in a pretty good place on-chain, in terms of on-chain data as well. We are seeing, as well as this, a few other indications that selling has at least decreased. And like we discussed previously, with Trump's inauguration just a couple of weeks away and all the promising things that could come of that, again, 2025 looks like it could be incredibly bullish, at least the first few months of 2025 until we potentially start getting overheated again. Everything looks very set up for a great few months for BTC.
So now accumulate as much Bitcoin as you can. This is the time to stack sats, if I can summarize that like that.
Well, so this almost plays into what we said previously with having different allocations of your capital. So dollar cost averaging in, I think now is a good area to begin dollar cost averaging in, continue to dollar cost average in. I don't think it makes the most sense to dollar cost average when we're seeing lots of on-chain points, really signifying that the market's getting very overheated. But yeah, I think now, if you are dollar cost averaging in, continue to do so. Every indication points to the fact that the top isn't in. And even if we are seeing diminishing returns, that could still mean a $200,000 Bitcoin in, under a year's time. And how many assets can double in just a few months outside of Bitcoin or more speculative stocks and stuff like that?
Do you think diminishing returns are there for Bitcoin in the future, or could there be like a major adoption wave in this S-curve adoption happening?
I still think diminishing returns are going to continue. As bullish as I am, there's lots of people more bullish than I am who could see a $1 million Bitcoin or something this cycle. You have to take into account, even though I think diminishing returns are going to happen, we could see diminishing returns in terms of percentage gains this cycle compared to last cycle and still see a $300,000 Bitcoin. That's how much room we have to go to the upside. Last cycle, we went from 3,500 to 69,000. If this cycle we go from 15,000 to 300,000, that still fits into diminishing returns, but provides $200,000 returns potentially per BTC. So I do think diminishing returns are going to happen, purely because as the market cap of an asset grows from a few $1 billion to a few $1 trillion, the inflows required increase exponentially. And I know we do have institutions coming in now, potentially corporations, potentially a strategic reserve, but that is still an incredible amount of BTC that needs to be purchased for the diminishing returns theory to break and us to go to $400,000-$500,000 plus in the next 12 to 18 months.
That I ask you, how does the power law relate to on-chain data?
So me and Giovanni have had some discussions. I'm pretty vocal in my dislike for the power law. I know that's going to upset a few people. Honestly, I can show you afterwards. I've had hours and hours of conversations with Giovanni. And as much as I think the power law does work in certain aspects, everyone will point to the evidence of it works in this nature point of data and it works in this and works in that. If we're mapping out Bitcoin's adoption, I can see power law being a somewhat useful model to do so. Mapping out Bitcoin's price, I don't think works too well. Power law changes every single day, practically, because it is best fitting for the data there. So while we see, oh yeah, we've only had a 5% deviation throughout 95% of Bitcoin's history, if you draw the power law from 4 years ago, it looks entirely different to what it does today. So of course, at some point, we might get closer and closer to that mean as we get more and more data. But overall, I'm not the biggest fan of the power law. And I know that will upset people, but I have to be completely honest. Same kind of thing with stock to flow. Stock to flow was only a cycle or two ago everyone's favorite thing of, oh, look at Bitcoin, it's destined to go to hundreds of thousands of dollars based on its relation in terms of its inflationary rate and circulating supply when compared to assets like silver and gold. But ultimately, stock to flow would inevitably fail because it would require Bitcoin to go to hundreds of trillions of dollars in just the next couple decades. As much as that is a useful model to map it out, and as much as power law might be useful for certain things, I wouldn't be the first to suggest using it for your own investing and analysis. Of course, if it works for you, go for it. I'm not going to judge anyone. If you use the moon cycles or if you use magic tarot cards or whatever, go for it. If it works for you, that's fine. But a data point that can change on a daily basis isn't, to me, something that should be relied upon too extensively.
It has more descriptive power and less a predictive power, I feel like. But yeah, I might have a power law discussion coming up very soon because I had Giovanni on, I had like Fred Krueger already on, I had Stephen Paranoid already on, and Stephen was actually the second most popular episode I had ever on, and it was like 40k views or something like that. It was going crazy. Only Seyr beat him. But yeah, I had some opposing views also on that where we focus on that, and there might be a debate coming up. Let's see if I can set it up. I think it would be fun to talk to do that. Really cool. When we come back to the institutional side, it's really interesting, as you said. We had 2017, and before, I think you said 2017 was the example where you said it was retail led, and now it seems to be more and more institutional led, the global price, the Bitcoin price movement, maybe even like country led. Let's see if something like that happens. How does this change the reality of Bitcoin, or maybe what impact does it has on chain data if the psychology behind an institution might be different than a psychology behind retail people?
Of course, that's a very, very valid point, and definitely something that is being discussed a lot within on-chain data communities over the past few months. Is if we're seeing 1 million BTC accumulated by these ETFs, potentially not to be seen again on the open market. Potentially that's just going to be held forever. Even if they are sold, they might be sold into dark pools and still stay on Coinbase custodian or something like that. Ultimately, while that may impact the numbers in terms of the amount of BTC being moved, it's not going to change human psychology. You have to take into account that if we look at Bitcoin in 2016, 2017, it's not like every BTC was traded from person to person. A vast majority of trading was going on exchanges like Binance. We would see Bitcoin being transferred to exchanges, traded there, which we can't really see that data before it would be removed. However, what we can see is this still gives a good reflection of when people are bullish or bearish, because they are still sending their BTC to exchanges or off from exchanges. So even if the ETFs are accumulating hundreds of thousands of Bitcoin, it's a spot ETF. They're going to have to buy that Bitcoin. And once we see that dry up, that's obviously going to give us some insights. But as much as I'm a proprietor of on-chain data, it is only one element of what your analysis should be. Like we looked at global M2 as a macroeconomic point of view, I do think on-chain data is something that should be considered. But now maybe we do have to consider institutional, corporate, and potentially sovereign state flows as well. If we're seeing countries secretly accumulating BTC, at some point that's going to come to light and we're going to know, wow, this is now an international settlement currency, and countries are now storing it and hoarding it and buying it, accumulating it like they did gold a few decades ago. So it's something that we need to look for confluence. If we're seeing, like we said, ETFs flows drying up or potentially outflows, alongside that, the just human psychology of people who have been in BTC for a long period of time begin selling, that gives us even more confidence that potentially a market cycle top is in. And another thing to consider is, even though Bitcoin has been accumulated in the hundreds of thousands by companies like MicroStrategy with over 400,000 BTC, if you aggregate all of the BTC held by the ETFs and corporations like MicroStrategy, it comes out at about 1.5 million Bitcoin, which is only about 7.5% of circulating supply. So I know, of course, lots of Bitcoin has been lost and Satoshi's coins, etc., which may never move again. Either way, there's still 92+% of BTC held by retail traders, people who've been in Bitcoin for a long period of time, people like me and you, who aren't institutions, who still have an overwhelming majority of the impact on the Bitcoin price action.
Interesting. That's an interesting insight, because a lot of people always bring up that argument of, oh, now the market is controlled by Michael Saylor and Larry Fink. That's what I sometimes also get as comments, which then you can point to the data and say like, oh, like no, 92% of the whole thing is not those two, and in those two it's like a lot more people involved. It's not like Saylor and Fink are doing it themselves and like, let's buy, let's sell, let's try to manipulate the price. How hard is it actually now to move the price? I remember when Elon Musk came in the scene and he announced, buying, and you can buy a Tesla for Bitcoin and stuff like that, and the market just went up like crazy. But then like a few weeks later he said like, I have some concerns about the environment, and then it went down again, I think, to a very similar price point before it went up. I remember that being the case. How hard it is, how hard is it now for an institution, a company, a huge corporation to move the price like that?
I think it's getting harder and harder. However, in saying that, markets in general, this isn't just specific to Bitcoin, markets in general are incredibly irrational. They always will be, because they are driven by human emotion. And this isn't just specific to investing markets. The entire global economy goes in booms and bust cycles where everyone's incredibly bullish before everyone becomes incredibly bearish. I think it's just a force of nature to have these cyclical movements, not just in price, but in human emotion and just general sentiment in all markets. I do think now it's getting harder and harder to manipulate, especially Bitcoin has now been solidified as this genuine asset. Previously it was this speculative thing that was used for thieves online and dodgy people to do, criminal activities, etc. The narrative has completely changed. Now we're looking at pension funds allocating multiple percentage to BTC to keep their clients happy. That's a massive narrative shift in just a few years. And the fact that now Bitcoin is so regulated and it is so large in terms of its size, it's much, much harder to manipulate. But still, if we are seeing, like you said, Elon Musk or whoever else coming out and giving these storylines, that isn't necessarily manipulation as much as it's a rational human reaction. If we see FUD coming out, like we always do at the tail end of bear markets, people read that, people react to it. If we're seeing on Twitter people buying new Lambos and going crazy, buying new watches, etc., it's hard not to get carried away with that and think it's going to continue going up. But again, this has always happened. This is always going to happen. It's an inevitability. But I do think as Bitcoin becomes a larger and larger asset, its volatility decreases and it stabilizes somewhat. It's going to be harder for individuals to have as big an influence as they have done historically.
Yeah, it's interesting. I remember when I was a huge Saylor fanboy in my first year of orange pilling, of getting orange pilled. This was around 2020 when he also came, and he was a lot asked of like, what do you think of the stock to flow model, of other price models, and then all the data there. And I remember him saying something of like, okay, what do you do in a game where a huge new player comes in? But I feel like we're already there. Like the hugest player on earth already are in the game somehow. BlackRock is in here. We have potentially America coming in. Of course, what happens if Apple tomorrow decides to convert 20% of the balance sheet to Bitcoin and announces that publicly? That would probably send some shockwaves across the market. But they're not that many big players left. Of course, the big corporations, there are a lot of wealthy individuals. But is that even, is that argument of like huge players coming in the market and disrupting all those on-chain data points, all the models that are around that, is that even possible? Or are we slowly above that point?
Yeah, so at some point, on-chain data is going to evolve, but it has always evolved. At some point, we may need to account for the fact that a majority of Bitcoin is illiquid and held as treasury assets by big corporations. I do think what we can see already with this institutional inflows, and like you said, there's not too many big players coming in. I think a lot of the big players coming in, like MicroStrategy, are never going to sell. He can't sell. Seyr can't sell because he would crash the share price because he's always had this narrative of never being able to sell. But a lot of corporations, even if it is only a few percent, will probably add Bitcoin to their balance sheets, and that's going to reduce the liquid supply of BTC. There's already, is it 94% of BTC that will ever exist are already in existence. So at some point, we are going to get to a point where there's just not that much BTC left for corporations to accumulate. And this plays into something called the money multiplier effect. I'm not sure if you're aware of that. But essentially, $1 flow into the market doesn't increase the market cap by $1. It increases that by a multiple of that. So it's hard to gauge exactly what that is. I would say it's somewhere between 4 and 7x. You've heard people say it's as high as 20, 50, 100 times that. I don't think that's the case. But if Bitcoin continues to get less and less liquid, then that money multiplier is going to increase. Therefore, it doesn't necessarily require every corporation to jump in with 100% of their balance sheet because the amount of available BTC is just continuing to decrease. I'm sure we've all seen the stats and tweets of there's not enough Bitcoin for every millionaire on earth to buy one. At some point, the supply and demand economics, are going to work in our favor. I mean, they already are working in our favor with Bitcoin around $100,000. But at some point when 10% of BTC that's available is only liquid for trading, every purchase is going to massively increase the market cap. But this is where there's also the narrative shift where these big institutions and corporations, are they really looking at the day-to-day price of BTC? Are they really thinking, I need to add at least 100 BTC to my wallet? Probably not. The narrative has probably shifted to say, I need to hold X percentage of my portfolio. In traditional investing, you never hear funds say, we want to own X amount of shares of this company, or we need to own this amount of the S&P 500, for example. They'll allocate 40% of their capital or 5% of their capital. So even if it's not X amount of BTC being purchased, if we see these corporations adopting that type of mindset to say, we need to have at least 5% of our balance sheet held in BTC, then the price is really irrelevant to them. But the price action that we'll see will be incredibly positive because of that supply and demand economics and the money multiplier effect we'll see from that.
That's a super interesting insight. Basically, you drive the price more up with your $1 than just that $1 because of the supply dynamics. Really cool. For people that now are curious, okay, where can I start? What should I watch if I want to get more Bitcoin and if I want to see more of the analytics? Where can they start? And especially what metrics are the, like, I don't know, best 3-4 metrics to look out for?
Well, so I might be a little bit biased, but I think the best place to start is bitcoinmagazinepro.com. And the second best YouTube channel after yours would, of course, be Bitcoin Magazine Pro, run by myself, where we try and educate people. But really, it doesn't have to be complicated. Like I said, I think obviously number one thing would be helping you accumulate more BTC, but a close second is helping you save some time. The number one thing, like I said earlier, when I first got into the space, I was consuming hundreds, if not thousands of hours of BTC content, learning how to trade and invest and do all of these wacky things. And it all turned out to not even be that impactful. These on-chain data points, by focusing on 3 or 4 of them, can really massively increase your profitability in a fraction of the time. So if it came down to like a top 3 all-star list, we'll say the MVRVZ score, I absolutely love, like we discussed earlier, which is looking at the relationship between the average accumulation price of all BTC holders and the current market cap. It's just a really nice way to see the mass psychology of, wow, we're at a 5x on our position. Historically, that is a pretty good indication that the market's getting a little overheated, or a majority are at a loss on their position. Again, pretty good indication that the market is potentially a little bit undervalued and you can get in at maybe a bit of a discount. Second one, I really like the spend output profit ratio. Again, these are all just looking at the supply and demand and profit taking of BTC. So I can just share this really quickly. 2 secs. Here we go. So the spend output profit ratio, what we can see is every single Bitcoin transaction, we can actually see how much US dollar profit they made on that position or how much US dollar loss they made on that position. So what we can see is periods where people are selling at an extreme loss, like at the tail end of bear markets, like in the COVID 2020 dip, like in the tail end of the 2018 bear market. When people are selling at a loss, this is when you need to buy when there's blood in the streets. Like I said, almost all of these prove that counter trading and moving in an opposing nature to the general consensus has almost always outperformed a vast majority of people. It is really reiterated in on-chain data like this. And same is true for the upside. Once everyone's euphoric, taking profit, seeing transfers to exchanges, usually a good indication that the market's getting a little overheated. And like I said, this has actually started declining slightly after we've surpassed $100,000 and had a little bit of retracement. So that'd be my second one. And then the third one would be something like this, which is the realized cap hodl waves. So this is a really interesting one. So the MVRVZ score we mentioned previously is looking at the average accumulation price of all BTC on the network. What we can actually do is see the influence of that realized price by different age bands. So just really quickly, what I can do is remove all of these age bands apart from, say, the 24-hour ones, and you're just going to see a little line on the chart. So what this is showing is, say, on December the 8th, 2017, over 13%, nearly 13% of the influence on the realized price or the price paid for BTC was made for people who entered the market that day, which is a huge amount. Considering Bitcoin at this point in time had been around for over 10 years, well, nearly 10 years, sorry, 13% of the influence on the average accumulation price of all BTC was made by people made in the last day is crazy. And if we just add on up to, say, 6 months and then add the Bitcoin price action back, what we can see is when new capital is flowing into the market and paying excessively higher prices than experienced traders, that usually really indicates that the market is becoming incredibly overheated. So again, what we can see in pretty much every single market peak is people come in and pay 60, 70, 80% of the average accumulation price just within the past few weeks and months to accumulate BTC. This is FOMO happening in real time that we can monitor. And just as something to note, currently we're at a pretty healthy level. We're seeing capital coming in, obviously driving prices higher, a lot of institutional inflows, but still at pretty tame levels, pretty comparable to what we saw in 2024 as we reached that first all-time high around $73,000, $74,000. So there is still significant room to go to the upside. But again, once we start seeing the warning signals flash, even if everything's looking positive, we're seeing great news events, everything looks in our favor, there's a strategic reserve, for example. When we see a huge amount of BTC's average cost basis being made by new market participants, that has always indicated that the market is overheated, and it likely always will. So this would probably be my third choice for a top 3 of on-chain metrics. Just to get started, all of these are free on the site. You can use them. If you get a site subscription, you can get alerts and access to other data. But it's just a way to dip your toes into this data to see if it works for you and your strategy. Those would be 3 good examples for you.
Really cool. Can you then also, if you see all the data of selling and buying, can you kind of label the smart money and the dumb money on chain and try to follow the smart money?
Yeah, exactly. So just as another quick one I had loaded up here, which is the 1-year hodl wave, which is the amount of BTC that had been held for at least 1 year. And typically what we see is the smart money, which are swing traders who hold Bitcoin for about a 2-year time frame based on the traditional 4-year cycle. What we can see is they begin massively offloading BTC as we get to these cycle peaks and begin accumulating BTC as we get into these cycle lows. And this is just a really simple way to just see the cyclical nature of smart money accumulating and distributing BTC. And that's just one example, but we have lots of different ways you can track this smart money. We can isolate the realized price by just short-term holders or long-term holders, by just balances holding X amount of BTC with certain charts, but just as a really simple way to visualize this and how long-term investors actually act in extreme market conditions, we see them massively offloading BTC as the market gets overheated. And now, again, we're seeing some profit taking like we have done at this stage in all previous cycles, but this isn't anything to worry about. This is completely healthy. This is what is driving price higher, this new capital coming into the markets. But at some point, we are going to see this bottom out and we are going to see the market peak. And hopefully you've scaled out enough to sufficiently buy incredibly more BTC when we get to the tail end of the next bear cycle.
Absolutely. Really interesting stuff. It's always fascinating for me that you can see so much from the on-chain Bitcoin data, and you can actually kind of see where Bitcoin is at and even drive decision from that. Data-driven decisions is always, in my eyes at least, a great idea, a good thing to do. what one thing that, because we're already at like 1 hour and there's so many questions in my head, but maybe we can do a part two. One thing I'm curious about you also, how has, since you got into Bitcoin in, I think you said 2017, how has Bitcoin shaped your understanding of money and investing, and maybe also then the on-chain data analyst?
So when I first got into Bitcoin, I'll be completely honest, it was to try and make just more money. I was working in a pretty boring corporate job, and I'd heard of Bitcoin years ago. I have a background in IT, networking and security. So I'd heard of Bitcoin, but I always thought it was just this fad thing. And here in the UK, investing isn't really that common or popular or talked about. It's not something that's really taught in schools. In America, it seems to be much more prevalent, the idea of investing and opening, 401ks, etc. In the UK, you have a pension which is managed by your employer, and that's really it. It's not a very popular thing. So when I first heard about it and heard I could make some money, there was a little gambler inside of me that wanted to, just try and make a quick buck. And it was only afterwards that I researched BTC, realized what was actually happening in the fiscal systems, the impact of inflation and how we're basically slaves to continuously produce and continuously spend just to stimulate the economy. And it's only after you kind of delve into that hole, I'm sure everyone watching this has been orange pilled to some extent, where you really realize, wow, what happened? Why did we go off the gold standard in the US? Why is the current world economic system built on this just constantly churning money printing? It doesn't really make any sense. So after making a little bit of money and then losing all of my money and then trying to learn as much as I could about Bitcoin, I realized that this is something I wanted to be involved in full time. So after that, I learned everything I could. I read every single book on the topic. I did every single online course on the topic. And then after that, I was convinced that I was going to rectify the mistakes I made previously. And it was as I learned about Bitcoin as a technology that I really understood, wow, we can see the supply and demand economics. We can see all of this activity in real time like nothing else. It kind of nullified a lot of the information I'd learned previously, a lot of the trading strategies and stuff, because it's not like traditional assets. People who would maybe be selling courses on how to trade gold and other commodities don't have access to even a fraction of the data that every single one of us has access to when it comes to Bitcoin. And it's very unique in that aspect that we can see all of these transactions and we can see the monetary elements of BTC in an open source nature, which is absolutely amazing. And it's something that, again, I hope I can be involved in for as long as possible and hopefully continue to educate and help people to understand the current financial systems that many are being, exposed to in the traditional world of finance. Hopefully help them to understand BTC and its scarce, limited properties, and hopefully, as well as that, understand the data so they can hopefully, even if it's just accumulating at the most opportune moments. I know most people don't even want to buy and sell too frequently, but if we can outline periods where we say, right, here it makes more sense to aggressively rotate into BTC. Here, maybe it makes sense to spend some of that BTC, put a deposit down on your house, whatever you want to do. Then that's great. That's my ultimate goal, to just try and help educate people on BTC, its properties, and the data we can use to best perform when it comes to our investments.
Really cool. How do you think long-term Bitcoin will be as an indicator for markets? I think if Bitcoin becomes a huge thing in our overall financial system, I guess Bitcoin itself, the Bitcoin price, Bitcoin on-chain data and stuff like that could be not only important for getting more Bitcoin, but also being maybe important market insights in the overall psychology of the people, if they're more saving, if they're more investing, if they're more whatever. Do you think that Bitcoin can evolve in that kind of insight in the overall psychology of the world's finance?
Yeah, 100%. And I mean, at the minute, we see Bitcoin being incredibly correlated to assets like the S&P 500, the NASDAQ, and traditional US equities, just purely because of its more speculative nature, I guess. But because Bitcoin is a 24/7 asset, it gives us this unique insight into seeing human psychology at all hours of the day. Whereas the S&P 500, for example, I think today is a trading holiday. We have no idea what investor thoughts are, but we can see from the Bitcoin market where we're down a few percent a day. Maybe people are a little bit bearish, and it gives us that kind of pre-market open insight into human psychology. And unless we see a BTC decoupling, which I could talk about for another hour or so, well, unless we see Bitcoin have this extended period of time where it has a at least reduced correlation to US equities and trades as its own asset, for the time being, we don't have that. We are still incredibly correlated to the S&P 500. If we do see a huge recession, I think Bitcoin is going to struggle. If we see a huge exponential bull rally continuing in equities, then again, I can see Bitcoin continuing to do incredibly well. But it is unique to see that human psychology on-chain because, of course, if Bitcoin's doing well and equities are doing well, and we start seeing on-chain data within the Bitcoin network to say people are beginning to sell, that could be this early indication for not just Bitcoin, but for all equities, for all investments, that maybe we are a little overextended, overjoyous to the upside. So it's very unique in that element.
Interesting. What needs to happen that we decouple from that? I think since I'm in Bitcoin, everyone is talking about that we will probably soon be decoupled from that. But I think it takes a little bit longer time. What needs to happen that Bitcoin is decoupling from risk assets, which just, I feel like it just means volatility.
I think we have now seen the catalyst for that to become a thing. The ETFs, the institutional offerings, I think was step one in this BTC decoupling. Previously, when it was retail driven, or even in the previous cycle when it was leverage driven by these companies like FTX, etc., like we discussed, that's still a very speculative asset where people were mainly using it as a means to make more money, let's be honest. Whereas now, like we said previously, where if the narrative is shifted as something where it needs to be added to everyone's balance sheet or portfolios, previously it was a 60% equities, 40% bonds or something. Maybe now we've changed to add 5% of Bitcoin into that. And I think that narrative shift is going to be one of the things that could lead to this decoupling, where we finally fulfill the narrative of a digital gold, if you like, where people don't necessarily tie Bitcoin to speculative assets or equities like the S&P 500. And it is seen as a hedge against inflation and traditional monetary policies with its unique monetary properties and its halving event and all of this stuff. I think the floodgates have opened, but I still think we might be a couple cycles away. Like I said, the ETFs and corporations currently having about 7.5% of the circulating supply. Once that gets to 20, 30%, which it will in not that long, considering we've got to 7.5% in, not very long at all. At that point, maybe we start having a conversation of, is BTC still correlated incredibly strongly with these things, or is it its own unique asset? And I think the big test of that is when we have the next big global recession, which has been just around the corner for years now. But at some point, we will get one. At that point, if we see Bitcoin begin to start outperforming massively a lot of things, even during a market-wide downtrend, then that'll potentially even catapult and snowball even more as more people say, wow, this is the asset that it promised to be, that it set out to be, this hedge against bad monetary policies and central bank printing, that even more capital flows into this unique asset, this unique scarce asset like Bitcoin, like gold, but Bitcoin being the digital gold that actually has some utility in terms of international settlement. If you try and send $100 million of gold, good luck with that. Then maybe that can be the real starting point of a true decoupling.
That's amazing. I think it would definitely happen, as you said. Really cool. We have one question that I asked each and every one of my guests, and the question is, what can we learn from you besides Bitcoin?
Wow, great question. When you said one question, I was almost certain you were going to say, what's the price going to be at the Bitcoin cycle peak?
I usually try to avoid asking that, but you can answer that also.
I prefer to not answer that. Hopefully, if you've learned one thing, it's to try and be a little bit more reactive with your investing and analysis than predictive. So I'm going to actually not answer that one. But what I'm hoping I can hopefully impart is a little bit of wisdom outside of just on-chain data and analytics, is to not spend too much time when it comes to finance and investing and looking through all this data. The reason I got into this on-chain stuff is because I didn't like spending all of my time in front of charts. There's no point in accumulating more wealth by just spending 20 hours a day locked up in a room looking at price action. If you can spend a few hours a month to have the same returns and spend the rest of your time doing things that are beneficial to you, your friends and family, physically, mentally, spiritually, whatever you want to do, then that is a two times win. Like I said, our biggest outperformance isn't just monetary gains in terms of percentages, but in terms of the amount of hours that you need to do this analysis massively being reduced, allows you to spend time doing things that you actually want to do and allow you to hopefully spend this wealth that you've accumulated through this outperformance.
Yeah, very, very true. Really cool. We have also another end routine, also not about the price.
Okay. Okay.
Where the previous guest is asking a question for the next guest without knowing who the next guest actually is. And the previous guest asks you the question, if you can give up your phone or your computer for a day, which one would you give up and why?
That's a good question. I think I would choose my phone because it would be harder to give up. There's quite a few days where I don't go on my computer. I try and limit myself to, have weekends off and stuff, where it's really hard to get away from your phone. I'll be the first to admit that. So if I could force myself to be away from my phone and actually talk to people, if that's still a thing, and go outside, if that's still a thing, and enjoy nature, then that'd be great. So I would choose that purely because it would be difficult and it would almost make me maybe appreciate the little things more and maybe appreciate the next time I get my phone back.
Interesting. So the computer for you is easier to give up, actually.
Yeah, I think so. I can get all my TradingView alerts and all my Bitcoin Magazine Pro alerts on my phone, so I don't actually need the computer to begin speculating and gambling.
Yeah, it's interesting because I could do everything that I do also on my phone, but I actually prefer the computer. So it would be so much easier for me to give up the phone because all the addictive stuff is also on my computer, like the Twitter feed is also on my computer. And when I'm at home, I usually I don't even know where my phone currently is, probably somewhere around the house. I think I'm more addicted to the computer. I don't know if that's good. Probably not.
Probably neither is good, let's be honest.
Yeah, absolutely. You should be addicted to get outside and have fun with your partner and with friends.
Exactly.
Which I will actually do right now. It's today is the day. I mean, not when this will come out, but today is 1st to the 9th of January. We have a meetup always in Vienna with Bitcoiners in Vienna, and this actually starts in like an hour. So I will go there today and do exactly what I'm supposed to do. Meet other Bitcoiners in real life.
Nice. Have a few shandies or non-alcoholic beers, I'm sure, and a schnitzel or two.
Yes, I will. I'm actually hungry, so I will definitely do this. Thank you so much, Matt, for already being on. And before I let you go, where can people find you, ask you questions, reach out to you?
Yeah, so BitcoinMagazinePro.com is the site where we've covered all of the data today, as well as 150 other live charts, TradingView indicators, that type of thing. On Twitter, we're Bitcoin Mag Pro, or if you just search Bitcoin Magazine Pro, you'll find us. And apart from that, that's about it, really. We have a YouTube channel as well, Bitcoin Magazine Pro. If you search that, if you search Bitcoin Magazine Pro anyway, you'll hopefully find all of our stuff. And that's it. I'd just like to say once again, thank you very much for having me. It was on pretty short notice as well, not like the audience needed to know that, but it was great for you inviting me on and having this chat. It's been great. And hopefully we can do it again sometime.
Absolutely. Let's do it in half a year. Let's see where the market is going and let's analyze it. I think it's really interesting for me, at least, to see. I hope also the audience gets the one or two nuggets out of that. Thank you so much for doing it. Also, thank you so much for everyone that is watching and listening. As always, I will be back tomorrow with another episode. Bye-bye.